What's up, YouTube? I'm back again with another video. I really appreciate your support and love for my previous video. I really appreciate that. I'm back with another video where I'm going to be talking about the basic of fair value gap and order block. Fair value gap and order block is very crucial in the financial market. As a price action trader, you really need to know those things because those things are key levels in the market where you can see potential reactions from, stand for continuations or reversal. So stay tuned as I dive into the lesson of today. Thank you. So let's start with the fair value gap. So what is the fair value gap? The fair value gap is an inefficiency in the market caused by volatility or red flag news. It's an inefficiency caused by volatility in price or red flag news, which is high impact news. So how do we identify fair value gap in the market? Like now, you see these two candles. They are very impulsive. You understand? Just two candles give us about roughly how many points here? Give us about 200 pips, just two candles. So that means that there is an inefficiency in this price action, and there was a very high impact news here during this particular period of time, or maybe there was volatility in the market during this time. So just so you know. And how do we identify fair value gap? Fair value gap is simply the gap between three candles. Is the gap between three candles. Let's assume that is our candle 1, and this is our candle 2. Then let's have our candle 3 here, and this is our candle 3. Let's assume this is our candle 3. Let me make it bold. Let me make the color very thick, and I will use blue since my candle are blue. Let me make this one the same color. Let's assume that this is our candles. You understand? The three candles I'm talking about is a kind of three candle formation. Before you see fair value gaps, you must see that three consecutive candles, you understand, to the direction in time. So like now, we have this is our first candle and this is our wick. Pardon my own wicks, but you manage it. This is our wick, this is a low, then this is another wick high. You understand? Then this is another week low, this is another week high, then this is another week low again. So we can simply, are you seeing this gap? Bring our tool to here, and you see that this is kind of inefficiency on that price action. This is an inefficiency in the price action. Let me make it faint somehow. If you look properly, you will see that there is a gap between these candles high, this candles low, and this candle high. That is called the fair value gap. The gap between these candles low and these candles high, which is the gap between your first candles low and your third candles high, is called the fair value gap. So let's look for that on our main charts, live charts. Now let's take these three candles. Let me take these three impulsive candles, 1, 2, then 3. Now look at these candles though. Like fair value gap is simply the first candles in three candles formation. It's simply the first candles low, then the third candles high. Now look at these candles low. Are you seeing it? Then look at these candles high. So there we have our fair value gap. So there we have our fair value gap. Here we have our fair value gap. If you look carefully, you will see tons of fair value gap. You will see tons of fair value gap, and I will also tell you how they work. Now look at these three candles again. 1, 2, 3. The gap between these three candles, this first candle's low and this third candle's high, is our fair value gap. There is inefficiency in this particular price action. Then another fair value gap again. Okay, let me show you where we don't have fair value gap. Now look at this price action. There is no fair value gap in this place. Are you seeing it now? So there is no inefficiency in this price action. Market has balanced everything here. All the price action here has been balanced. There is no inefficiency here. So there is no fair value gap here. So that is fair value gap for you. So let me quickly tell you how it works normally. Fair value gap, since there is an inefficiency, you can trade fair value gap in two ways. Either you are trading price to your fair value gap, or you are trading from the fair value gap. So what do I mean? Now this price action, now you see that if market was in this position and you saw this fair value gap, you know that this place has an inefficiency and price need to balance it before continuing to the downside, right? Either you trade price to go and balance this fair value gap, or you simply wait for price to get to that fair value gap to balance the fair value gap, then you trade the continuation. That is one of the simplest patterns to trade fair value gap and the use of fair value gap. Either you are trading the fair value gap to go and be balanced, or you are trading it for continuations, because price actually respect those gaps. You understand? Anytime you see price coming to a fair value gap, you will see a reaction to the upside. Anytime you see price getting to a fair value gap, you will see reaction. That is how fair value gap works. It's very effective. So now let's go to order block now. Let's talk about order block. The definition of order block. An order block is simply a block whereby price mitigates for continuations or reversal. So let's take a look at the different types of order block. There are two basic types of order block. We have the bullish order block, then we have the bearish order block. You understand? The bullish order block is when price mitigates it and give us a bullish continuation. And why the bearish order block is when price mitigates the order block and give us a bearish continuation. So in better understanding, the differences is that the bullish order block is simply the last bearish candle on a bullish price leg. Then the bearish order block is simply the last bullish candle on a bearish price leg. So now let's look for the other blocks on the main market. Now if you look at this chart very well, you know price has been trading downward. You understand? Low, high. Price has been trading downward. Then you see this bullish candle. You see this bullish candle in the midst of thousands of bearish candles. So this bullish candle alone now is another block. This bullish candle is another block. There are different kind of order block, but let's talk about the main order block. This bullish candle is another block. So what did price do? When price mitigates that bullish candle, what happened? Price continued the down movement. So this is a bearish order block, which is a bullish candle, right? I said before, bearish order block is the last bullish candle in a bearish price leg. Market mitigates it and continues to the downside. So let's look for a bullish order block. You can only find a bullish order block in a bullish price leg. Now let's look at this market very well. Okay. Now this is a perfect example of bullish order block. Now price has been trading upward. Then price has this last bearish candle before the push to the upside, the momentum to the upside. So what you do is that you just use your rectangle tool and draw the other block like that. So what did price do? When price gets to that other block, it mitigates the other block, sweep the liquidity to the downside. Then what did price do? Continues to the upside. So that is the power of other block. Now price has been trading upward, right? Then we still have another last bearish candle. Like I said before, a bullish order block is the last bearish candle in a bullish price leg. Now we have this, the black candles here on this chart is my bearish candles, while the blue candles is my bullish candles. So please take note of that, don't be confused. So price mitigate that black candle. Then what did price do next? It trade to the upside. So that is other block for you. Other blocks can serve as demand zones or supply zones or resistance or support, depending on how you use it. You understand? All these things are kind of, they work together, just terminologies, you understand, is depending on how you term your price actions, you understand. Sometimes I use other blocks, sometimes I use demand, sometimes I use resistance. Whichever one that fits the most, I use it at that particular period of time. So that is other block for you. Thank you very much. So that is the basic part of fair value gap and other block. If you really enjoyed this video and you find it interesting, please do it to like, share and subscribe to this YouTube channel for more content like this. Thank you. Peace out.